Hi, Master. Hello. So once again, sorry for the technical issue. We're live as the boys at technical inform me. So once again, we're going to be mixing technicals with fundamentals, and in front of your screens you have the US dollar index. It's the four chart. All charts to be presented are to be of the same time frame unless otherwise stated. Would be noting more or less once again that we have a US dollar index which tended to drop yesterday, and it was characteristic how the index dropped, breaking the upward trend line we had just shown, but also breaking the S100 and 155 support line. Now we have to turn this into resistance line, definitely. Let's go hunting for a new ultimate support line. Okay, I would be noting this level as we had a number of touches on the downside as a support line, but also as a resistance line. So that would be in green, the 98.85. Readjusting the chart, mind you that we had to go back. Give me a sec. All the way back to April last year. So we're talking about 12-month low here. For the time being, though, let's correct also the labels, reposition them and correct the labels. Starting with the R3, which is now being placed at 103.45. Sorry, give me a sec. 103.05. Let me reaffirm this. Yeah. The R2, 102.45. Pretty narrow exit actually, but still, due to the touches we have, seem to be valid. 101.55 with the S1. Sorry, the R1, and the S1 now is being placed at 100.65. The S2 at 99.80. And the S3 at 98.85. Yeah. So overall, for the time being, we tend to maintain a bias for the sideways motion, but you cannot just ignore the downward motion, especially given that it has driven the RSI indicator clearly below the reading of 50, which more or less tends to imply that the bearish sentiment is building up, which could drive the index lower. Possibly for a bearish outlook, we would require a clear break of the S100.65 support line. On the other hand, should the bulls regain control over the index, I wouldn't be surprised to see it breaking above the 101.55 and start aiming for the 102.45. It's going to be a very, very interesting day today. as on the fundamental side, we have definitely the Fed's interest rate decision, which is going to be most probably turning volatility up. Mind you that we have been watching media over the past 24 hours, and there's lots of hype being built up around the Fed's interest rate decision. So we may see some increased interest on the release as such. Now, the bank is expected to hike rates by 25 basis points. Fed funds futures imply probability of such a scenario is materializing currently at around 86%. So the market is pretty widely pricing in the scenario of a possible rate hike of 25 basis points by the bank. Mind you that the Fed funds futures also imply that should the bank hike rates by 25 basis points as expected today, then we may expect the next movement to be that the bank will be remaining on hold practically for the months of June and July as well as August. And early September, it's going to be cutting rates by 25 basis points, followed by another cut in November, and possibly remaining on hold in December, if not cut rates again. So overall, the market expectations are A, for a rate hike today, B, to remain on hold over the summer, and start cutting rates practically from September onwards. Now, should the bank actually deliver the 25 basis points rate hike, that should provide actually some support for the US dollar as such, given that we have around 13-14% of the market expecting the bank to remain on hold. But I think that most of the attention on a fundamental level is going to be turning towards the accompanying statement and especially the forward guidance of the bank. Now, should the Fed maintain a hawkish tone, which may more or less imply that more rate hikes are possible, that would contradict market sentiment, which expects the bank to remain on hold and start cutting rates. Also, it's going to be interesting to see whether the bank is going to be implying that it will maintain the tight monetary policy settings in place for a prolonged period of time, say, for example, up until the end of the year, which would also be contradicting market expectations for a possible cut in September onwards. And that could also create some substantial support for the US dollar. On the other hand, should the bank deliver 25 basis points hike, as we have mentioned, but in the accompanying statement show some hesitation or may imply that the interest rate is nearing its peak if it hasn't reached it already, then we may see more or less the USD weakening substantially. And in such a case, a bearish sentiment may be so intense that we may see the sideways motion turning into a bearish outlook. It's the main release of the day. Mind you that besides the Fed's interest rate decision today, we also get the US employment report for April on Friday. So that's another volatility factor for you there. And I think that, okay, at the Fed's interest rate decisions, we always expect higher volatility than usual. But in this case, given also the overall hype which we have mentioned before is building up in the media, we may see the volatility extending beyond the FX market. Also, say, for example, on stock markets or gold's price, or if I may add, even oil's price. It's characteristic that oil prices yesterday dropped and dropped considerably, partially expecting that the Fed's going to be hiking rates, maintaining a rather tight monetary policy, and that may have an adverse effect on economic activity and thus oil demand. Now, markets practically priced in this in advance and allowed for oil prices to drop. Besides the width and the ripple effects of the possible interest rate decision of the Fed, I would also be highlighting that we may see volatility being prolonged not only at the time of the release, but also on Fed Chairman Powell's press conference that would be about half an hour after the release. Should the Fed Chairman actually proceed with some hawkish commentary, we may see once again the market sentiment turning bullish for the US dollar and bearish for gold and US stock markets, and vice versa. So practically given the high volatility expected, I wouldn't be surprised to see the price action of the US dollar index rising if it's a bullish one, breaking above the R100 and 155, reaching the 102.45, and maybe even breach it. It's going to be a very, very interesting session. On the other hand, should the bears take over, I would expect the price action to drop, break the 100.65, and aim, if not even reach or breach, the 99.80 support line. Now let's move to Euro USD. Euro USD tends to maintain a sideways motion, possibly benefiting a little bit from the USD weakness. So it may be on the rise, but overall we see that it well respects the R1 1.1075. So overall we tend to maintain our bias for sideways motion to continue between the R1 and the S1. As you can see in the yellow rectangle, we have highlighted the price actions sideways motion since around the 12th of April. On the other hand, I would be noting here that there is an indicator is on the rise, aiming for a reading of 70. It's not there yet. It's quite low. It should be at around 58. Let me have a look. 57.8, yeah. And, sorry, 58.4. So that tends to imply that slowly but steadily, bullish sentiment seems to be building up for the pair, which may push Euro USD higher, mostly due to USD weakness side. Should that be the case, and for a bullish outlook, we would require the pair to clearly break the R1 1.1075 and start aiming for the 1.1220. On the other hand, should the bears take over, we may see the price action of Euro USD dropping, breaking the S1 1.0925 and start aiming for the 1.0760. Okay. Let's have a look at cable. I have to cover this gap here as well. There you go. Now, GBP USD also had some slight upward movement, but overall the sideways motion seems to be maintained between the 1.2540 and the 1.2350. It's interesting how cable, also had some slight bullish tendencies, but it's not as obvious as it is with Euro USD. By the way, thank you for the nice comments, guys. Our bias for the sideways motion of the pair is to be maintained between the 1.2540 and the 1.2350. Once again, though, the Fed's interest rate decision could alter that, and that goes practically with all trading instruments which we are going to be displaying today. In which case, should the bulls take over, we may see the price action of cable being finally able to clearly break above the 1.2540. Since the beginning of the month, practically it was able to do it only once, and you can see it encircled in red here. Everything else was within the boundaries set. So should the R1 be broken, the 1.2540, then the next possible stop for the bulls may be the R2 1.2770. Let's open and unlock the chart. I would like to see where the R2 actually rests on. Okay, beautiful touches on the R1. Single touch here. Okay. Back to the forward chart. And readjusting it. Now, should the bears take over for bearish outlook, we would require a clear break of the S1 1.2350 and the price action to start aiming for the 185. So that should cover cable for the time being. Let's have a look for USD JPY, which had a very interesting movement yesterday. Here you are. A very, very happy analyst, as we were able to foreshadow exactly the importance of the 137.75 resistance line yesterday and highlight this possibility. Note how the pair dropped after hitting a ceiling at the R1. And it's interesting that it dropped practically rolling with it. Also the RSI indicator, which has dropped below the reading of 50. Mind you that it was at 81 and has rolled down over the past 24 hours with all the way down to 44. And that exactly highlights how the bullish sentiment was diminished practically. And actually the market sentiment now worries that the USD may the USD may weaken even further, allowing for the pair to drop lower. Should the bears maintain control, we may see the price action of USD JPY rolling below the S1 135.15, which used to be more of a resistance line. Note how it provided resistance here and here and has now been turned into support line, given that the price action has clearly moved above it. Next possible stop for the bears would be the 133.55 support line. But given also to the proximity of the S1 to the S2, we may see USDJPY in an intense bearish movement, breaking the S2 as well, which would pave the way for the next possible target for the bears, and that would be the 130.40. Note how it was aimed for here, tested here and here, false break here. It's going to be a very, very intense and interesting movement. On the other hand, should the bulls take over once again, that would allow us practically to start drawing an upward trend line, as we would have a considerable through here. It's a considerable consolidation of the price action. Yet for a bullish outlook, we would require a higher peak than this one. So the price action has to break above the R137.75 and start aiming for the R239.40. Okay, let's have a look at USD CHF. Okay, USD CHF finally was able to drop decisively lower. Definitely the 0.8935 support line has now to be turned into resistance line. And we have to go hunting for a new ultimate support level. Let's unlock the chart, go back in time, find a suitable true if possible. Okay, we can see the touches of the S1, of the S2, Moving out to the daily chart. Give me a sec. We have a touch, and that's all the way back to 2015. We're talking about an 8-year low here in green. $0.8680. Locking it in. Readjusting the chart back to the 4-hour chart. Once again, readjusting it. Let's correct also the labels. Starting with the R3, which is now being placed at 0.9115. The R2 at 0.9020. The R1 at 0.8935. The S1 at 0.8860. The S2 at 0.8760. And the S3 at 0.8680. Okay, so locking everything in. For the time being, we note the bearish movement here and note how the RSI indicator has dropped below the reading of 50. It's actually aiming for the reading of 30. It's now at 35.4. That's a pretty bearish sentiment, which may push the price action to drop below the S1 0.8860. And the next possible target for the bears would be the 0.8760. Mind you that we're talking about an almost 12-month low here, or let me reaffirm this, an 8-year low. And yeah, now the S2 was for the last time touched in December 2020. While the S3, we have to go all the way back to 2015. There is a small catch here. The catch is that the price action has dropped below the low Bollinger Band. And that's an interesting feature. It could actually slow down the bears. And in such a case, we may see the pair stabilizing just about or around the S1 0.8860 level. For bullish outlook, I would require the pair to rise, break the R1 0.8935, and start aiming for 0.9020. Okay, let's have a look also on AUD. AUD USD on the rise. Note that the pair has reached, after a nice downward movement over the past 24 hours, a make or break position. It's currently testing the upward trend line we had just drawn yesterday. And should it be breached, we may see the pair stabilizing, possibly just above the 0.6625 support line. It's interesting how the RSI indicator has dropped but remained slightly above the reading of 50. It's currently at 53.3, and that tends to imply a rather indecisive market, in my opinion, for the time being. I would like to see, for a bearish outlook, I would like to see the pair actually breaking the S1 0.6625 and start aiming for the 0.6520. Definitely a lower true than this one. And the RSI indicator has to drop below the reading of 50 and actually approach the reading of 30. For a bullish outlook, we may see the price action reversing direction, proving this break to be a false break, and aim higher towards the R1 0.6755. It's interesting how the pair, despite the USD weakness, actually lost ground. It would be something which I didn't expect actually. Possibly the risk averse sentiment of the market may have had an adverse effect also on the Aussie, which is a commodity currency and thus is considered to be more risky. And it drove the pair lower. Nevertheless, for a bullish outlook, once again, we would require a higher peak than this one. That would practically mean that the pair has to rise and reach, if not breach, the R1 0.6755, which also provided resistance here and here, was briefly broken here and here. Let's move to USD CAD. USD CAD, which was on the rise, and that was practically yesterday. But since the late American session has started to consolidate a little bit here, and it's consolidating just below the 1.3645 resistance line. So for the time being, we tend to maintain a bias for the sideways motion to continue of the price action of the US dollar against the Canadian dollar. And such a sideways motion could be maintained between the R1 and the S1. It's interesting how the RSI indicator has flattened out just above the reading of 50. It's actually right now at 58. So that may also imply that, or if you prefer, allow for the sideways motion to be maintained. Should the bulls take over, I would require the price action to break clearly the 1.3645, not just a false break like here, but a clear-cut break, possibly even providing, with the level providing some support. It's characteristic how strong the level is, given that it was extensively tested to the upside here, to the downside here, here, aimed for, tested here, aimed for here, and tested here. So it's a pretty valid level here. It may prove a little bit more difficult for the bulls to break. On the other hand, should the bears take over, we may see the price action of USD CAD dropping, breaking the S1 1.3545, and start aiming for the 1.34. Okay, let's have a look at the Kiwi against the US dollar. The Kiwi, which in contrast to the Aussie and the Canadian dollar, maintained its strength against the USD, allowing us to draw a nice upward trend line here. Note that it had higher peaks, higher truths. Definitely the R1 has to be turned into support line. I would be noting this level. It's a little bit narrow, know it, but it's a nice support line. Let's color this in red now. And also highlight as the next possible resistance level here. $0.6535, 0.6430. Let's readjust the charts. Give me a sec, because we had some interesting releases from New Zealand during today's early Asian session. Yep, we'll discuss them later. For the time being, let's correct the labels, starting with the R3, which is now being placed here, the R2, the R1, the S1, the S2, and the S3. The S3 being placed at 0.5980, the S2 at 0.6090, the S1 at 0.6190, the R1 at 0.6270, the R2 at 0.6360, and the R3 at 0.6430. Now, before we discuss direction, I would like to have a look what happened with the release of the New Zealand employment data. Let's drill to the 1 minute chart, unlock the chart, widen it. It's a beautiful movement here. And what had happened is that we had got the New Zealand employment data. It was interesting how the employment change growth rate practically accelerated, or if you prefer, was higher than what was expected. It was expected to come out from 0.2 to 0.4. It came out to be 0.8. And that was impressive. It quadrupled practically. And that was for quarter one. At the same time, I would be highlighting also that we had an acceleration, maybe not as high as the market expected, of the labor cost index on a year-on-year level. It rose from 4.3 to 4.5, which may imply that the employment market in New Zealand may continue practically feeding inflationary pressures within the New Zealand economy. And the unemployment rate, which was expected to tick up from 3.4 to 3.5, it didn't. It remained unchanged at 3.4%. Overall, the data were quite positive, with the participation rate for quarter one being at 72%. Quite interesting here. And that would be more or less, in my opinion, data which tended to provide support for the Kiwi. Let's have a look at that. We're in the minute chart. Let's go back at the moment of the release. Not much volatility here. There was some slight support for the Kiwi of around 10 pips, nothing much. But the data was solid. And if you see also Governor O's statements about the New Zealand financial system being well placed to handle higher interest rates, all of that tends to point towards a more hawkish approach from RBNZ, which could continue to provide support to the Kiwi on a monetary policy level. So for the time being, hello and a good morning to Anil as well. And for the time being, we tend to maintain a bias for the sideways motion to be, for the upward motion to be maintained as long as the price action remains above the upward trend line we have just shown. Should the bulls maintain control, given also that we have the RSI indicator, which, okay, it corrected a little bit low, but it remains still at pretty high levels at 65. Then we may see the QE against the US dollar rising, breaking possibly the R1 0.6270, and that may allow it to start aiming for 0.6360. Once again, as we have discussed with all the FX pairs we had, given that one component was the US dollar, definitely the Fed's interest rate decision is going to be key regarding the direction in the coming 24 hours. On the other hand, let's have a look at gold. Gold's price jumped. And I would be readjusting the resistance support lines here. Definitely this flattening out, in my opinion, tends to show a resistance level. Why? Because you have one which is further back. Somewhere here. On the other hand, it was tested here as well. On the other hand, the support line could go lower. So we're still in the sideways motion. We're talking about the 2020. Mind you that the R2 is at 2070, which is an all-time high. And we can see it if we drill into the daily chart, I think. Let's unlock the chart here. Here it was. Yep. We are adjusting the chart back to the 4-hour chart. Let's reposition the labels. 2100, then the R2 2070, the all-time high, then the R1, the 2020, which is the current ceiling for the price action of gold, moving lower to the S1, which is now being placed at 1970. Yep. The S2, which is being placed in 1935, and the S3 considerably lower at 1890. So On the one hand, we see a continuance of the sideways motion of the pair. It's going to be interesting whether that's going to be maintained or not. Note the RSI indicator, which is pretty high. It's actually just below the reading of 70, and currently it's at 66.3. So that tends to imply some slight bullish tendencies here for the precious metal, which may push it higher to break the R1 2020 and start aiming once again for the all-time high level of 2070. For a bearish outlook, despite that seemingly being improbable, it's still a possibility, and we should cover it, especially given that should the Fed's interest rate decision strengthen the US dollar, then we may see the negative correlation of the USD with gold's prices coming into effect and pushing the precious metals price considerably lower. In that case, we may see the pair dropping below the 1970 support line, which would allow it to start paving the way for the 1935. We're talking about a channel as wide as around $50 here, which is going to be a very, very interesting movement. Okay, let's have a look at US stock markets. Actually, I would like, before we move to US stock markets, I would like to have a look at WTI, which dropped yesterday. And here it is. It's a clear-cut downward movement, which is being maintained. Actually, it intensifies. The bearish sentiment is very strong for oil. Okay, let's correct this and set it as a resistance line. It has even dropped below the reading of 70. We haven't seen this for a while, actually since the end of March. Let's go hunting for a new ultimate support line. It's a little bit narrow in my opinion. Let's go further back. Here it is. This is a nice clear-cut true, and this level actually was able to reverse the downward movement to upward movement. It's still narrow, but this is more solid. 61.70. In green, please. Let's readjust the levels, the chart. $80.50 being, so that should be 90. Give me a sec. 80.9. Okay. 80.90 being the R3. The R2 being set at 76.80. The R1 at 73.90. The S1 at 69.10. The S2 at 64.30. The S3 at 61.50. 0.70. Note how the RSI indicator has dropped below the reading of 30, implying a very intense bearish sentiment on behalf of the market for the commodity, and it's currently at 20.4. Now the pair's RSI indicator under the 4 chart, okay, definitely underscores the bearish sentiment, the intense bearish sentiment of the market for commodities price. On the other hand, though, may also be warning us that it may be reaching oversold levels and may be ripe for a correction higher or some sort of stabilization. The same also applies with the price action breaking just below the Bollinger Band, the lower Bollinger Band. Also showcases the intense bearish sentiment, but also warns us that a possible stabilization could come into play here. Note how the commodity price is actually fast approaching the S169.10 support line. Once again, for the time being, we expect the bearish sentiment to be maintained. And we would like to draw a downward trend line here, like this. The commodity price has intensified its slope. Okay, let's have a look at Dow Jones. Actually, before we move to Dow Jones, I would like to have a look at another FX pair, and that would be USD-TRY. Daily chart, please. A very, very strong weakening of the Turkish lira. Which intensified practically since the end of February. This is the daily chart, let's not forget it. So we tend to maintain a bias for the bearish outlook of the lira. Oh my god. The RSI indicator in the daily chart is clearly above the reading of 70. Possibly a weakening of, or a slowdown if you prefer, of Turkey CPI rates did not actually help the lira. On the contrary, it weakened it further. Okay, let's have a look at Dow Jones as promised. It's going to be a quick glance here. Note the downward motion of Dow Jones. Yet in the pre-market hours, the index seems to be stabilizing somewhat after hitting on the 33,500. So for the time being, we tend to maintain a bias for the sideways motion to continue, but I would be highlighting here that we may see intense market movements given the Fed's interest rate decision later on. A guy of you guys has requested to have a look at NZD-USD. Definitely. It's Lupe Beats. Give him a sec. We saw that already. But we would be highlighting here the upward motion of NZD-USD. We expect it to hit the next boundary for the bulls at the R1 0.6270. But it all comes down to the Fed's interest rate decision. Should the Fed's interest rate decision actually weaken the US dollar, we may see it even breaking the R1 and start aiming for the R2 0.6360. On the flip side, should the USD actually strengthen, then we may see it dropping, breaking the slight upward trend line, breaking possibly also the S1 0.6190, and start aiming for 0.6090. The RSI indicator still implies some slight bullish sentiment in agreement with our bullish outlook, but, and it's a big but, it's correcting lower. So keep an eye out for that. Hope I was of any help. So from all of us here at IronFX, best wishes for solid trading.
Welcome to another quick deep dive video. Today we'll be talking about financial instruments, what they are and the different types that exist. To start, a financial instrument is a contractual monetary asset. Think of it as a real or virtual legal agreement with monetary value that can be traded, purchased, modified, or settled. Financial instruments are typically divided into three types: cash instruments, derivative instruments, and foreign exchange instruments. Cash instruments are financial instruments that are directly impacted by market conditions. Examples of cash instruments include securities like stocks, bonds, or options, which are traded on the stock market, or deposits and loans, which represent monetary assets agreed upon by borrowers and lenders. Derivative instruments are financial instruments that derive their value from an underlying asset, for example, interest rates, indices, or other assets. Foreign exchange instruments are considered unique. They are financial instruments represent on the foreign market. They are comprised of derivatives and currency agreements. Currency agreements are themselves subdivided into three categories: currency swaps, outright forwards, and spots. A currency swap is the buying and selling of currencies with different set value dates. Outright forwards are currency agreements in which currency exchange occurs prior to the date agreed into the agreement, and a spot in a currency agreement in which the actual exchange of currency happens no later than the second working day of the agreement's original date. Financial instruments also have two classes of assets. These are known as debt-based financial instruments and equity-based financial instruments. A debt-based financial instrument is usually used as a tool to increase the amount of capital in a company. This includes bonds, mortgages, debentures, credit cards, and others. Equity-based financial instruments normally represent legal ownership of an entity, for example, stock. Thank you for watching.
Okay, welcome everyone to today's session. Today's session, we're going to touch on Fibonacci confluence, right? Particularly the Fibonacci confluence trading strategy. As the name suggests, right, confluence means there's not only one level there, but there are multiple Fibonacci levels that line up exactly there, right, to create a high probability reversal zone. Okay. Now, as usual, remember, if you have questions, don't hesitate to ask it anytime throughout the webinar. Right, I'll do my best to get to them, right? And of course, to begin, right, risk warning. Remember that everything in this webinar is educational in nature, so please do your own little due diligence before you guys trade. Nothing should be construed as investment or trading advice. Okay. Now, so for those of you guys who do not know who I am, my name is Desmond Leong. I run the award-winning research firm Everest Fortune Group, also a Forex Army, right? I'm finalist for the best FX and best equity research in 2019, 2020, and 2021, right? So recently been taking a couple of prop firm tests too, right? I think my Forex funds is the most recent one that we passed, right? And yeah, it's today's webinar will focus on the Fibonacci confluence trading strategy and how I actually use it. All right, it's a reversal strategy. Okay, It's a reversal strategy, so it works really well when in overbought and oversold situations. But you do need to have a lot more confidence when you use it, right? Meaning that it's usually against the market. So if I have my pen over here, right? And my pen over here, usually when you're taking a reversal trade, the market is going against you, right? It touches and then it reverses. This is what we call a reversal kind of contrarian style of trading. It's slightly different, right? So it's not the usual breakout trading. So most people are comfortable with a breakout trading, means that price breaks out and they play all the way down, right? This is because when price is dropping very strongly, you feel a little bit more comfortable trading the direction of price, right? But the Fibonacci confluence trading strategy is slightly different, right? It actually plays the reversal, right? It actually plays the reversal. That means you need to have a little bit more tolerance for risk, right? Especially when you see prices coming down and then you choose to play in the opposite direction. Okay, it's a lot scarier, right? But it can also be a lot more rewarding because you can get a pretty good risk to reward. Okay, now let's begin today's session. Right, I'll be touching on a couple of things here. Questions, remember to feel free to send it through directly to me. Send it in the Q&A part. I'll do my best to answer them. Okay, let's begin today's session. Okay, so let's first touch on ideal market structure. Okay, ideal market structure, right? So this is the part where okay, there you go. When you're trading Fibonacci, right? When you're trading Fibonacci, right? One of the things that you want to do is you want to look for ideal market structure, right? You don't want a market that is too it's like too messy, right? You want to look for the markets where there are very, very clear movements, right? And this is what I mean by that, right? You need the markets with very, very clear movements. You want to look for the big movements. You don't want to look for the small movements like this. Okay, now let's of course move on from here, right? There are two things that you need to take note of when it comes to drawing Fibonacci, which forms the basis of our entire trading strategy, right? When you draw Fibonacci, you'll notice that there's this dotted line that goes all the way through when you're drawing it. This dotted line needs to follow price as closely as possible, right? It needs to follow price as closely as possible to be profitable, no, to be accurate and relevant, right? So in this example, when price is like moving in this direction, the Fibonacci retracement is not very effective because price tends to deviate quite far. Price tends to deviate quite far from the dotted line. You compare that with this. When you draw a Fibonacci retracement like this, from here to here, you notice how nicely price follows it, right? Even from here to here is okay, right? It deviates just a little bit. In these kind of situations, the Fibonacci is a lot more effective because it follows price more accurately. Okay, so that's the first two things that you need to take note of about market structure. Okay, that's the first two things you need to think about when you're drawing Fibonacci retracements. Your retracement should ideally follow price structure as closely as possible, because only then will it be can you get an accurate Fibonacci retracement. So I just need to drink a bit. My throat, oh shucks, my throat is hurting a bit, so I do excuse me if I take a couple of sips here and there. And of course, when I accidentally spill it on my mouse, oh god, just give me a second. Okay, now let's continue, right? So this is the correct way. Now, a Fibonacci, let me explain to you what's a Fibonacci retracement, a Fibonacci extension, a Fibonacci expansion, and a Fibonacci projection. Okay, there are four different things and they are used differently. So if you know how to use them, that actually unlocks the secret to trading. If you ask me personally, right? Unlocks the secret to trading if you know how to use this properly. Okay, so for example, Fibonacci retracement, you only pick one point and you pick a second point. Okay, when you pick 2 points, you then be able to your starting point and your ending point. You are trying to see how far price will then retrace upwards. Okay, So you tend to have a few traditional 23%, right? 38%, 50%, 61. This basically means like how far you're retracing. If you retrace 50% of the entire move, that means if the total drop was 100 pips, right, and you retrace 50% of the move, it means that it's a 50 pip, it's a price has moved back up by 50 pips. Okay, so that is basically what it means by Fibonacci retracement, right? 23, 38, 50, 61, all these different numbers, it basically is simply, right, the percentage of the move, right? So if price comes down and drop all the way here, if it bounces up by 50%, it basically means that it has retraced 50 pips, right? Assuming the drop is 100 pips. And if it retraces more than that, right, this is the 61, this is the 78, right? It basically means how much of the original movement it is recovering from. Okay. Now the next thing we do is Fibonacci projection. Fibonacci projection is a little bit more complicated, but it basically means you are taking, you see the starting point here and the middle point. Okay, you are taking the distance of the starting point to the middle point, right? You're taking the distance, like let's just say the distance is 100 pips, right? And you are projecting it onto here, which is another 100 pips, right? So that is what it means by 100% Fibonacci projection. Okay, it means that you're looking for price to touch and then bounce from there. Okay, we are looking for price to touch and then bounce from there. So that is basically what a Fibonacci projection means, right? I'm going to erase it over here. I'm going to draw it again for you. Very simply, Fibonacci projection means that you're taking the distance from, if you have a movement like this, you're taking this movement, it could be 100 pips, and you're projecting it over here, maybe another 100 pips. This is what I mean by a 100% Fibonacci projection over here, right? So we have stuff like the 100%, we have the 61% projection, we got the 78% projection. All of it basically means that, you're taking the distance and you're multiplying it by 61, 78, or 100, right? When you're forecasting when the reversal is going to happen. That is the meaning of Fibonacci projection. Now let's talk about Fibonacci expansion. It kind of looks like the same thing, but you only have one starting point and one ending point. Price must minimally retrace at least 50%, minimally 50%. So if it retraces to 61 or 78, it's fine. What then happens is that you forecast price to go up to reverse off the negative 27% level, right? And you can see that has happened very nicely over here, right? So this is the trick to Fibonacci expansion, right? You are literally just forecasting when price is going to reverse, okay? You're literally just forecasting when price is going to reverse right here. Okay, it's a very, very important rule too, right? Because it is one of the few market leading indicators out there, right? It's one of the few market leading indicators to help you like forecast at what point in the future is price going to reverse. Very few other indicators are able to do that. Okay, guys. Now the last one I'll talk about is called Fibonacci extension, right? So Fibonacci extension, I call it like a Nike tick. You have your starting point of your Fibonacci retracement here and your ending point over here. It will then retrace two key levels, 127 and 161.8. Those are the important Fibonacci levels that you need to refer to. Okay, and once you rise up, right? Once you rise up to the 127 and 161, what happens is that price tends to reverse from that level. Okay, so that is what we call a Nike tick. Nike tick is very, very straightforward. Okay, it's a very, very straightforward setup, right? And you're looking to play the reversal from the 127% or the 161.8%. I'll be showing you some examples of this later, but the key thing here is that we have looked at Fibonacci retracement, extension, projection, and extend. The four Fibonacci, four types of Fibonacci. How we're going to use that is this concept called confluence. Okay, it's this concept called confluence, right? So as you can see, we can start with the Fibonacci projection, 100%. We can start the Fibonacci retracement, expansion, extension, and we found 1, 2, 3 reasons why price might bounce off this area. So this is the meaning of confluence, right? You line all of them up together, it creates a nice area. And what happens is that when price tests that level, tests the area, it tends to reverse very nicely, right? Because you have not only 1, but you have 2 and 3 reasons why price might bounce from that level. Okay, so that is the concept of Fibonacci confluence, right? You don't just trade it you don't just use a single Fibonacci to trade it. You combine multiple of them together to be able to execute the trade, right? Usually it's a reversal trade. Okay, guys. Now let's look at some examples, right? So we take some time to look at a couple of examples on using Fibonacci confluence. Okay. Just I probably need to turn off my video over here just so that it doesn't mess with the charts. Sorry, just let me load this. Let me just make a copy, right? Okay, let me show you some examples of Fibonacci confluence. We try to look for them together. Oh, sorry. We try to look for them together, okay? So I usually have my Fibonacci retracements when I draw it. I have this thing, all the different Fibonacci levels over there. When I use all Fibs, okay? When I use all Fibs, it actually shows me everything. So over here, the middle part is what I call Fibonacci retracement. And once it retraces beyond the 100%, this is what we call Fibonacci extension, EXT. And if it comes down here and it comes further down, this is what we call Fibonacci expansion. Okay, these are the 3 types of Fibonacci, right? We got the retracement, we got the extension, and we got the expansion. And these 3 will actually unlock a lot of the key secrets, so how you can call reversals. Okay, let's take a look at some examples. We're looking at euro dollar now. Actually, let's look at pound dollar. When you draw a Fibonacci here to here, what do you notice, right? I'm just going to highlight one key level, 127%. You will notice I'm going to do a bar replay feature over here, right? That price actually went all the way up, right? Price went all the way down. It went all the way up. It touched the 127% and it retraced back to the 100%. This is a very, very good trading strategy, which I use by myself, right? I use myself and I reach a decent amount of profit, right? I see if I have the picture over here, right? But basically, just let me see if I have it. There you go. You know, it's a good 8% that we made over here already. So as you can see, let's do a save as a detailed report. Yep, detailed report. There you go. Right. Yeah, basically, it's a good amount of trades that you see over here, right? You got about 8% profit, right, with a 2% drawdown. It's enough to 2.7% drawdown. 80% win rate for short position, 50% win rate for long positions, right? Right. Most of our trades were profitable, 65%. So it's a nice 65% hit rate, right? Pretty good risk reward. Like average profit is 1147, average loss is 920. So you know, managed to make pretty good, decent money with this setup. Okay. Now it is the setups I took was purely from here, right? We take the reversal of the 127 and play it down to the 100%. Okay. Now the success of this strategy lies in confluence. Sorry, just give me a second. The success of this strategy lies in confluence. Okay, what I mean by confluence? In this particular setup, right, if I were to do a bar replay feature, so I think it was a 4-hour chart. Right, in this particular setup, when we did the Fibonacci retracement, Fibonacci extension, I noticed there's a 127 over here. The 127 also happened to line up with this swing high resistance. Okay, this multiple swing high resistance, meaning that I have 127, I got one swing high, I got two swing high. So it's a high enough chance, we got one, we got two, we got three reasons why price might touch this level and reverse. Okay, we got three reasons why price might touch this level and reverse. And true enough, from there, right, let's go bar by bar. Right, price actually comes up here, touches this level, and reverses very nicely. You can see it reversed and it reached our 100%. So this is what I call the Nike tick strategy, right? You're really just looking to play the reversal of 127 all the way down to 100. How you can improve this strategy is one of it, of course, having a very clear Nike tick, right? Very clear V that you're looking for. The other is when you combine it with support and resistance. In this case, we got swing high, right? Price reacted once, reacted twice. When price finally came up again, it was going to react again. So there were three reasons why price was going to drop. Okay, combine that at 127% extension, the Nike tick kind of Fibonacci extension, you got even higher probability trading strategy. Okay. Now, of course, you can combine it with different forms of Fibonacci. Let's try to see if I can find any over here. Let's see. I'm trying to find one with a little bit of a Fibonacci projection too. Let me see if I can find a good example with one with a Fibonacci projection. Okay, this is one example. This is one example over here. So let me just make sure I get this right. So as you can see over here, right, very nice Fibonacci extension. This is a nice little Nike tick that you're looking at, right? You can see it's a very, very nice Nike tick. And it comes all the way up to here, this 127. Okay, I'm going to leave this 127% over here. Because at the same time, there's a very nice Fibonacci expansion, right? Remember the rule for Fibonacci expansion. The rule for Fibonacci expansion is that price needs to minimally retrace 50% of the entire move, right, before you can consider a bounce, right? So we got over here 127 and negative 27. So what we call a confluence area. This is a confluence area. Okay, so what then happens is that we wait for price to reverse from this level and play the move down all the way down to here. This would be where we play the reversal from and until. Okay, so here we go, right? So we can see price, bar by bar, it starts to reverse, it starts to reverse, There we go. And price will have hit our take profit then. Okay. It's a simple enough reversal that you're looking for, but you notice that I will not trade based on the 127 alone. I mean, based on 127 over here, right, a zigzag Nike tick, right, 127 is already pretty strong, right? But if you throw in this Fibonacci expansion with a negative 27 up here, them combined, right, actually causes, it gives you a much more higher probability setup, okay? Now, if you really want to really improve your probability of you getting a good trade, I believe you could throw in a little bit of RSI, because you can see over here for the RSI, right, when price was starting to do the reversal at the key level, right, it was a bearish divergence. And bearish divergence is when the price, the highs of the price is going higher, means it's climbing, right? And in this case, stochastic RSI is going down. So in this example, right, it's a bearish divergence, right? We have not only the 127, we have not only the negative 27, right? We also have a bearish divergence, versus stochastic, no, versus RSI. So that gives you a good probability that price is gonna drop. Okay. Okay, I see a couple more people over here, right? Let's see, Mr. John, right? Yosef, right? Damir, Mr. Damir, are you around? I just want to make sure that you can hear me clearly, right? If you can hear me clearly, feel free to send a message in the chat. All right, Mr. Damir, right? Okay, let's continue today's session, right? So this is an example of finding a Fibonacci expansion along with a Fibonacci extension. So this is expansion plus extension plus divergence. Okay, all three of it lining up very nicely to call this reversal over here. Okay, let me try to look for a couple more examples. Right, so we got Kiwi dollar. Okay, there we go. This example, I should be able to show you a little bit more confluence over here. So I tend to look out I tend to use the Fibonacci extension as the leading indicator of what might happen. So the Fibonacci extension usually works when you start to spot a letter V. Whether it's a V or inverse letter V, the moment you see it, right, it is time for you to start mapping out your Fibonacci extension, right? So the moment I notice this letter V over here, whether it's an inverse V, I start drawing a Fibonacci retracement from one place to another place. Okay, now that it's over here, what I then do is I will highlight the 127% Fibonacci extension over here. Okay, so we're looking for the reversal for price to come all the way down to here, touch this 127 and come back up to the 100%. Okay, it sounds like a simple enough setup, but if you get it wrong, it can be very dangerous. Okay, so 127 over there. Okay, let's see how price actually panned out. Bar by bar, you can see it go down, go down, go down, go down, go down. It touched the entry, right? And it bounced back up to the 100%. It might even bounce before that, but yeah, it bounced up to the 100%, right? You see it come down, touch the 127, then it do a small little nice bounce. So this move is all you need to make money, right? You don't care about what happens after that, but this move is all you need to make money. Okay, yeah, so that's another example of using the 127 Fibonacci extension, right? I'm going to try to find an example for you where there's a Fibonacci projection. Okay, we got another example over here. Okay, in this example, right, we can see that price is starting to create a nice little ladder V, right? As you can see over here, right? It's starting to rise up nicely and it's starting to reverse. Okay, we look at the 127% extension over here and we're like, okay, looks interesting. I then do a Fibonacci projection with this as the top, the middle, the ending point. What we then notice, right, I'm just going to remove everything and leave the 127 over there, is that there is a 127 and there's a 78.6 Fibonacci projection, right? So it's all lining up over here, this area over here. That means my pending order will be in this region, okay? What happens when it's like this, right? We can see, let's show you. Price pass, touches that level, and it bounces back up, right? So you have been able to play this little bounce here, making you a fair bit of money, right? So it's all about finding the extension level and combining it with like other forms of technical analysis. You can use the Fibonacci projection, you can use a Fibonacci expansion, and you can use a Fibonacci retracement. So if you were to use a Fibonacci retracement in this circumstance, let me see if it works out. Usually it's a lot harder. Yes, usually a lot harder. Yeah, okay. We'll leave that out. Okay, so that is a great example of using Fibonacci extension with Fibonacci projection, right? I'm going to go through a couple more examples, guys. If you have questions, please ask them, right? Don't hesitate to ask them, all right? Try and find a few other good examples of Fibonacci. There we go, right? This is another really, really nice example, which might just line up with a bigger retracement story. Nope, right? But it might line up on the shorter term time frame. Let me see. You can see that price actually goes all the way down over here, and it's starting to form a nice little Nike tick, right? And it actually comes all the way here, touch the 127, right? And then reverse back down to the 100%. Okay, so this is another example of using a Fibonacci extension. The trick, guys, is really in finding the tick. It's not easy to find the tick, but once you find the tick, you know, you're a lot trading is a lot easier for you, right? The trick is really in finding the tick. Let me see, even in such a situation, can you find a tick? Yes, you can, right? And if you can find the tick, you probably can find the extension. Okay, you can find that. Okay, let me show you another example, a really, really good example. Okay. We can see price over here, right? It looks like it's going to form a nice little reverse Nike tick. Okay, so we take a Fibonacci retracement. We start from the bottom here and to the top. Okay, we got a nice 127% Fibonacci extension about there. At the same time, you know, you have a nice little Fibonacci expansion. Price goes down, retraces minimally 50%, right? But it doesn't kill you off completely. You know, so here you go, retrace minimally 50%. In this case, it retraces all the way up to here. Then looking for the move down. Okay, so here we go. Here, touch the 78.6, and we can see a negative 27% all the way down to here. This lines up with a 127% Fibonacci extension too. And of course, we got one more level, which is the major Fibonacci projection, right? From here, all the way down, all the way up, and we have a 61.8 Fibonacci projection here. So we got 1, 2, 3. We got 1, 2, 3 reasons why price might bounce, right? So we're going to highlight this area over here. Okay, I'm going to highlight this area over here. And what we're expecting is for price to actually come down, touch this level, and bounce up minimally to this level where it kind of broke out from. Okay, and this happens way too often, right? We can actually see price come down, come down, come down, test that level, and then it bounce up. As you can see over here, it bounce up and it kind of hit this take profit. Okay, this is one of the beauties of Fibonacci confluence, right? You find an extension, you find a retracement, you find a projection, you find an expansion, extension, right? All of it lining up together, at least 3 of them lining up together. It gives you a really good setup where you can play a small little bounce from the entry to the breakout level, the 100% where you were at. Okay, guys, you can combine this with support and resistance. You can combine this with trend lines. You can also combine this with Fibonacci, right? So the key is what I call Fibonacci confluence. Try to at least find 2. You can find 2 that lines up is great, right? So you got your Fibonacci extension, right? You got Fibonacci retracement over here. You got Fibonacci expansion, and you got Fibonacci projection. Okay. This fall, you minimally must have 2. I usually like to find retracements with projections. They tend to work very well. I like to find extensions with projections too. Okay, I really like to find extensions with projections when they line up over here. 127 and the 61.8 usually works out quite well. Projections and retracements work quite well. Extensions and retracements also work out quite well, right? And of course, extension and expansions tend to work a little bit less, right? But they can work out well. As a supporting argument, if you get expansion after having the rest, right, it's worth consideration, but I will not use it by itself, right? So I kind of put this maybe in red. Yeah. So if it's a expansion with anything else, it's not effective. But if an expansion as a supplement to the other Fibonacci's, right, it's actually a pretty good setup. Okay. Now, guys, I spent a good 40 minutes explaining Fibonacci to you guys. I'm just going to open the floor for 1 minute for anyone who has questions regarding today's webinar. Right? Does anyone have questions regarding today's webinar? Okay, so now that I'm moving away from from the slides, no, from the charts. Turn on my video again. Does anyone have any questions regarding today's webinar? Right, if you know how to master Fibonacci well, it will really help you when you're finding confluence, when finding reversal. It's very effective in finding reversals, less effective in finding breakouts. Okay, now, okay, I can see that there's not many questions coming through, and I appreciate that. I hope the explanation was clear for you guys. Right, thanks for taking the time to come to today's webinar. Right, I hope you found today's session useful. Apply in your trading, whether it's any form of retrace Fibonacci. If you can use it to combine and find areas of confluence, not only with Fibonacci but with other support and resistance, with other price action levels, right, you can actually come up with a very good trading strategy. Okay, now that's it for me, guys, today. Thank you very much for staying throughout. Right, if you have no questions, end today's session. I'll catch you tomorrow for a live trading session. Stay safe, trade safe, and I'll catch you guys tomorrow and next week.